Welcome back, Focus Learners, to another Explainer. Today, we've got a truly massive transformation story on our hands. We're looking at Powerfleet and unpacking their results for the fourth quarter and full year fiscal 2026. Now, if you follow the AIOT space, the artificial intelligence of things and connected mobile assets, you already know this company has been on a rigorous, multi-year journey to completely reshape its business model. They've been aggressively pivoting away from just selling hardware, moving toward becoming a high-margin, software-as-a-service powerhouse. And honestly, based on these latest numbers, that pivot isn't just some future plan anymore. It's practically complete. We have got some absolutely incredible data to get through today, so let's jump right in. Okay, let's dive into this. 42%. That is the massive year-over-year surge Powerfleet just posted in their fourth quarter adjusted EBITDA. Listen, when a company tells the market they're executing a strategic turnaround, this is the exact metric you want to see. Revenue growth is great, sure, but a 42% jump in core operating profitability over a single year, that's the ultimate proof that the underlying economics of the business have fundamentally changed for the better. So here's our roadmap for today's explainer. First, a defining fiscal year. Second, the SaaS and services surge. Third, expanding margins and profitability. Fourth, the South African landmark deal. And finally, we'll wrap up with their financial outlook for 2027. All right, kicking things off with Section 1, a defining fiscal year, accelerated growth. Powerfleet's CEO, Steve Towe, really hit the nail on the head summarizing this momentum in the earnings release. He stated, Fiscal 2026 was a defining year for the business. We delivered on our objectives to accelerate growth, compound profitability, and establish a consistent, growing cash flow profile. He goes on to say they are entering 2027 as a stronger, more focused company. I absolutely love this quote because it highlights the three non-negotiable pillars of a successful enterprise software business, right? You need growth, you need that growth to actually be profitable, and you need it to generate real, consistent cash. And the numbers absolutely back up his statement. Just look at this comparison. For the full year, total revenue came in right at the top of their guidance range, hitting $443.8 million. That's a very healthy 22% increase over fiscal 2025. But the real magic, that happens with adjusted EBITDA. It didn't just grow by 22%, it exploded, growing disproportionately by 44% to hit $97 million. Think about that. When your profit is growing exactly twice as fast as your top-line revenue, you've unlocked some serious operating leverage. Moving right along to Section 2, the SaaS and services surge, driving transformation. Now, what's really interesting about this slide is that ratio right there. In the fourth quarter, 81% of Powerfleet's total revenue came from services. That's $92.9 million in high-margin recurring revenue, compared to just $21.5 million from hardware and products. For a company operating in the industrial IoT space, hitting an 81% mix is literally the holy grail. It means they're no longer sweating over the low-margin headache of selling physical boxes in a volatile supply chain. They are a true software-as-a-service provider now, deeply embedded into their customers' daily operations. And keep in mind, this services surge isn't just coming from jacking up prices. It's backed by incredible, massive scale. Powerfleet has expanded its Unity platform to nearly 3 million subscribers across 50,000 customers. Let me tell you, you do not hit 3 million connected assets without a massive competitive moat. They're achieving this incredible reach through a highly differentiated distribution network, teaming up with global telecom giants like AT&T, TELUS, and MTN to push their software out to the enterprise market. Let's shift gears a bit to Section 3, expanding margins and profitability. Operating health. With that recurring revenue base firmly established, we need to look at how it actually flows through the financial statements. Now, if you just glance at the headline GAAP numbers, you might see a net loss of $2.7 million for Q4 and, well, kind of scratch your head. But as focused learners, we know how to demystify the accounting jargon. GAAP metrics often include a lot of non-cash noise. We're talking depreciation, amortization from past acquisitions, stock-based compensation, all that stuff. When we strip all that noise away to look at the actual cash-generating power of their core operations, we see an adjusted EBITDA of $26.4 million. That is the true reflection of the business's operating health, and it's a huge improvement from where they were sitting just a year ago. And a huge reason for that operating health is organic margin expansion. Because those high-margin services are becoming a much, much larger piece of the overall revenue pie, Powerfleet's overall gross margins are organically expanding. Look at this jump. In Q4 of fiscal 2025, gross margins sat at 52.8%. By Q4 of fiscal 2026, it expanded by 370 basis points to 56.5%. It's pretty straightforward. Software simply costs less to deliver per incremental unit than hardware does, so every single new subscriber drops significantly more profit straight to the bottom line. So how does this all translate into tangible cash flow? Over the second half of fiscal 2026, Powerfleet saw a massive $17.8 million improvement in free cash flow. Think about this trajectory here. In the first half of the year, they were burning cash to fuel their transformation and integration efforts. But by the second half, they successfully crossed that critical threshold into positive cash generation, bringing in $4.1 million. They are officially funding their own growth now. All right, on to Section 4, the South African landmark deal. Enterprise adoption. So the crucial point is how this technology actually plays out in the real world with mega enterprises. To ground these financial metrics, let's look at Q4, when Powerfleet signed a landmark agreement with the South African National Treasury to deploy their Unity safety solutions. And guys, this isn't some small proof-of-concept pilot program. This is a massive 5-year contract with an anticipated total contract value of $100 million to $120 million. Revenue from this deal is going to ramp up over the next 18 months. It's a perfect illustration of their land and expand strategy, securing these massive enterprise agreements that lock in guaranteed long-term recurring revenue. And hey, if you're wondering if that South Africa deal was just a lucky one-off fluke, it absolutely wasn't. In fact, Powerfleet secured the 3 largest individual contracts in the entire company's history this year. That included 2 other separate deals with total contract values over $10 million each, one with a top 3 global food and beverage company and another with a major global manufacturing enterprise. On top of that, their specific Unity on-site safety segment grew an incredible 39% in the fourth quarter alone. The enterprise market is clearly, resoundingly responding to their AIOT safety solutions. Which brings us to our final section. Section 5, Financial Outlook for 2027. Compounding Momentum. Let me tell you, this guidance table is genuinely a thing of beauty if you love seeing compounding momentum in action. For fiscal 2027, Powerfleet is projecting total revenue between $485 million and $490 million, which comes out to about 10% year-over-year growth. Crucially, they expect services revenue alone to surpass $400 million. But take a close look at adjusted EBITDA. They are projecting $122 million to $125 million. At the midpoint, that is a 27% year-over-year growth rate. Once again, profit growth is projected to vastly outpace revenue growth. Plus, they expect free cash flow to accelerate to somewhere between $30 million and $35 million. And this brilliantly illustrates the why behind those numbers. The secret to squeezing 27% profit growth out of just 10% revenue growth, it all comes down to pure discipline. Over the past 2 years of integrations and acquisitions, Powerfleet has ruthlessly executed on cost synergies, exiting fiscal 2026 with $34 million in total realized savings. They've streamlined their operations, they centralized their platforms, and brought true discipline to their operating expenses. The heavy lifting of their transformation is largely in the rearview mirror, and now those savings are permanently boosting their profit margins. Which leaves us with one ultimate massive question. As that South African Treasury contract fully ramps up and as they continue to layer highly profitable software subscriptions onto their base of 3 million connected assets, can Powerfleet compound this incredible operating leverage well into 2028? The foundation is absolutely built, and the momentum right now is undeniable. Thank you so much for joining me on this Explainer Focused Learners. Keep analyzing, keep learning, and I'll see you on the next one.